ChargePoint stock is down 98% off its high. Hopefully you listened to my recommendations and avoided this stock. I've had this rated as a sell or avoid for several years now. And in this video, I'm going to revisit ChargePoint stock and look at the company and answer if it's finally time to buy ChargePoint stock because of the significantly lower valuation. Is all of this price decrease finally making ChargePoint an attractive investment? I'm going to look at the company's revenue growth, cash flow from operations, return on invested capital, and finally compare all of that against its valuation to determine if it's finally time to buy this struggling EV charging stock.
I want to thank The Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
You can see the price action here for ChargePoint stock down 97.6% off its highs that were reached in 2020 and 2021. Of course, I've had this stock rated as a sell for several years now. I last updated this recommendation on December 5th, 2024, reminding investors to avoid the stock. In this video, I'm going to look at the company again, and you can see here revenue growth has all but ended. It's now decreasing. Trailing 12-month revenue, $431 million. It's down from the highs of around $500 million reached in 2023. And I think I've been talking about this ad nauseum for the last couple of years now. The forecasts for electric vehicles were way overblown. And these were back in 2019, 2020, 2021. And I was saying this since then, that investors, market participants were way too optimistic about the electric vehicle industry and its prospects. The electric vehicle industry was forecasting significant growth and that the majority of vehicles would be electric vehicles by this time, or at least demonstrate significant growth, which we haven't seen. In fact, in Germany, we actually saw a year-over-year decrease in electric vehicles of almost 20%. Decrease in EVs sold in Germany, where energy prices are much higher than they are in the US. And the key thing that happened there was the government removed some of the subsidies. So you could see the organic demand for electric vehicles is not strong. Consumers without incentives are not looking to buy electric vehicles, at least especially in the US too. If you look at the US, more than 9 out of 10 vehicles sold are internal combustion engine or hybrid. Only less than 1 out of 10 are choosing electric vehicles, and that's with thousands and thousands of dollars of incentives. Imagine where sales would be without those incentives. So that's why I've been bearish on EV stocks, ChargePoint in particular, and rated the company as a sell. A lot of investors wanted to hope that electric vehicle sales would increase and that the future would be all electric vehicles. I don't know. I'm not so convinced about that. I'm not convinced that electric vehicles is going to be the direction that the car industry goes in longer term. Maybe hybrids become an attractive option, an attractive bridge before electric vehicle technology improves enough where it makes sense for more people. Right now, it makes sense for only a very small percentage of the population. It makes sense for them. A very small percentage of the population where everything is just right for you to own an electric vehicle compared to an internal combustion engine vehicle. And I don't see that changing anytime soon, unless there's a huge innovation in battery technology that makes charging a lot more convenient. As it is right now, charging is incredibly inconvenient for the vast majority of the population, and we're seeing that throughout the industry as sales are struggling. Everywhere outside of China, the Chinese government is really incentivizing consumers over there, and those incentives, along with the local supply increase, lower priced models, is increasing adoption for electric vehicles in China. Almost 3 out of 10 vehicles sold in China are alternative energy vehicles, not internal combustion engine. So outside of China, EV industry sales are really struggling, and that's going to be bad news for ChargePoint, as 2025 is expected to be a lot more of the same, especially if in the United States, the incoming administration, there's been speculation that they are going to remove incentives for purchases of electric vehicles. And if that's the case, and if we look at the example of Germany, sales could decrease for electric vehicles in the United States year over year, close to 10, 15, maybe 20% if those incentives are indeed removed. Now, that's just speculation at this point, but that is a huge risk for EV stocks like ChargePoint. The company's losing significant sums of money on the bottom line, and it needs to reach a much larger scale for the business to be sustainable. But as you saw in the previous slide, it's not growing, it's actually declining. So it's a double whammy for ChargePoint, where it's losing 67% operating profit margin negative, and growth has stalled and reversed. The operating margin is improving, but this is a result of lower costs. And when you're a business that loses money on each dollar of sales, when you reduce your sales, you improve your profit margin, because with every sale you're making, you're losing more money. And so if you become more selective on the sales you're making, then you help improve your margin, which is something that has been necessary for ChargePoint, because after years of huge losses on the bottom line, their balance sheet has become very strained. The cash flow from operations, similar story, years of huge losses, but that is improving. So that's been good news for ChargePoint stock investors. Negative 185 million though, trailing 12-month cash flow from operations, negative 185 million. That's almost 50% of revenue. Revenue was 430 million in the trailing 12-month period. So huge losses for ChargePoint have persisted. The return on invested capital, negative 55%. Very little improvement here. If you look back from 2021, it's actually down from that point where it was negative 30%. It's now negative 55%. A couple of quarters improvement here, but not enough to really signify an improving trend. The company hasn't found a way to efficiently invest in this technology in a way that generates profits and returns for shareholders. It just hasn't figured out a way to do that. The costs to implement the research and development, the production, the installation, sales, everything, they just haven't figured out a way to do it at this small scale. They're counting on the fact that if they were to grow by, let's say, 5-10 times the level they're at today, maybe at that large scale they can generate profitability, but not at these levels. The valuation is the lowest it's been in 3 years. It's trading at a forward price to sales of 0.995, or you can say 1. That's down from the forward price to sales of around 12 it was selling for in 2022. But I argued back then it should have never been trading at those valuations. And I told investors to sell if they had an opportunity to sell, or avoid if they hadn't already purchased. So at 0.995, is the company's stock finally a buy, or at the very least a hold? I'm going to say no. I'm going to say this stock is still a sell. It's still an avoid. The industry, it's just a really bad industry to be in. It's not just the charging stocks that I don't like. I also don't like electric vehicle stocks overall. The industry is nowhere near where it needs to be in order for these companies to be profitable. And that's even with the trillions of dollars of government stimulus worldwide, which seems to be trending backwards, right? You already saw Germany remove stimulus for electric vehicle industries. You're seeing speculation of the United States potentially reducing or removing stimulus. And the trend is in the opposite direction. So I'm not liking this industry or this stock specifically. Did you know that over 90% of the people that watch my channel are not subscribed? It'll really help support my channel if you hit that subscribe button. And oh, by the way, one of the benefits of being subscribed is that I take requests from subscribers more often than I do from non-subscribers. So if you prefer that benefit, please subscribe to the channel.